Hi everybody. Sorry for being late. There was some technical issue. Well, good morning to everybody. Welcome to yet another session of Beyond Bulls and Bears by Team StaG. We'll wait for 30 seconds for everybody to join and then we'll start our session. Let's start the session. Thanks for joining and welcome to the session. Uh, the good point which I want to highlight here is that after 6 months of volatility and negative spiral, the market saw two back to back good months. In March, Nifty was up around 6%. In April, it was up around 3% after having a very bad start due to the tariff announcement by Trump. In the month of April, we also saw Bank Nifty touching an all time high. The market seems to be stabilizing. I will not say that the confidence is back because whatever is happening on the in terms of Indo Park is creating another, I would say, anxiety among the investors. So markets are trying to find their feet and stability. This week, the volatility was also little less compared to the past. What we saw this week was a consolidation with a positive bias. Uh, the market seems to be in a zone where the confidence of investors is coming back, but the worry related to how will India react to the Indo-Pak situation is a bigger worry. With apparently Prime Minister cancelling his Russia trip and a lot of people being parked in Delhi and talks going around, it's quite apparent that India will take some action in the near future, hopefully. How big that will be and what will be Pakistan reaction to that is something which is creating some nervousness in the market. But the good part is market is holding on to it. One of the reasons market is holding on to it is because of the earnings. I feel if I talk about earnings, broadly, I will say roughly 40-50% of the Nifty weight have come out with their earnings so far. And broadly, the earnings are much better than the trend we saw in the last 2 quarters. In fact, I will say that we have seen more earning upgrades this quarter than earning downgrades. The pace of the earning growth on the revenue side continues to be better than what we are seeing on the margin side. As inflation and cost to bring that revenue up seems to be more than what the market was estimating. But overall, I will say that the earnings are a lot better than what we have been seeing for the last 2 quarters. If we look at the commentary of the management, they also sound a lot better now compared to what it was. We believe that a part of it is driven by the fact that the government is back to its spending mode, and that has kick-started the private capex also. Please remember one thing that barring the first quarter of FY26, we'll be working with a very low base for the next 3 quarters, which means on the face of it, the next 4 quarters should see a very good YOI earning growth. And that for me will form the lower base to the valuations and the levels in terms of Nifty. Market is doing something which is part of consolidation. I will say sector rotation. We saw IT doing pretty bad at the start of the earnings season in April, but we have seen some short covering, some catch up by the IT also in this rally. Banks are doing well. Talking about earnings, let's cover portfolio stocks which came out with earnings. Uh, let's just start with SBI, which reported the earnings yesterday. I will say the SBI numbers were pretty good. Why I'm saying pretty good? Because while the growth was a slightly lower, the provisioning was a slightly higher. Overall, the margins were good in spite of falling interest rate. Asset quality was very good, and overall, the numbers looks from a core banking perspective was pretty healthy. SBI reported an EPS of around 80 rupees for FY25, and we believe that they will grow their EPS by at least 15% in the next 1 year, which means they should be doing around 92 to 95 rupees. Now, SBI with this kind of a growth and and a credit cost of only 0.4%, that's probably the best in the industry. Rather, 0.38%. I don't see why SBI should trade at less than at least, if not 15, at least 10 PE, which means that there is little downside in SBI. Please remember, in this rally, SBI is one of the least participating banks. So, from the perspectives of fundamental, I'd see little downside for SBI from current levels. It is also trading at one time book, which is, I don't see SBI trading below that. So there's a huge margin of safety. There's a good probability of re-rating if the market sentiments improve and the credit growth pick up. I won't I will rather go ahead and say that I won't rule out a 1200 exit price a year down the line for SBI. That's the view we have based on the numbers which we are seeing and the growth we are plotting. The other portfolio companies during the quarter which reported number, something which we are known for is Zomato. Now, if you look at the Zomato numbers, again on the face of it, it looks that they miss on the profitability and a bit on the revenue. While the revenue miss was more to do with, I would say, a technical factor, which is lower number of days of operations, and also the fact that they have done rationalization of restaurants in their food business. But the miss in the profitability was because of accelerated investment in Blinkit, where they have added a lot more stores than their traditional run rate. Again, something which makes us believe that Zomato is ahead of the competition with the strong cash flow it has, remember, it has stopped burning at EBITDA level on the console. It has enough books, enough cash on the books, and enough headroom to continue to invest in a phase where the competitors are burning to do the same investment. Which means today or tomorrow the competitors will have to slow down, and that is where Blinkit will monetize. In a revenue company like of the size of 21,000 crores a quarter, which is nearly a bit less than 1 lakh a year, 1% margin move is huge in terms of EPS. So yes, profitability is getting delayed, but at the EBITDA level, the company is pretty healthy. I would say operationally, the company is pretty healthy, and there is no change in our thesis for Zomato, where we want to reiterate that we see this company growing the earnings multifold, and in terms of if you put EV to EBITDA or revenue market cap to revenue model, we won't be surprised with a 3x in 3 years for this stock from here on. Another company which came out with the numbers was Maruti. Maruti reported a disappointment in margins. It reported the margins in the lower end of the band. If you look at the Maruti numbers on a steady state basis, they report margins in the range of around 11 to 13%. They reported a bit less than 11%. I think it was more, as said by the management, it was contributed by multiple factors. One, because of higher discounting, there was a 40 bips decrease in the margin. There was some decrease because of inflation, commodity inflation on the input side. There was some because of higher expenditure on promotions and marketing. I think a bit of it also was to do is to prepare for the launch of Vitara, which is expected in by Q2 FY26. Uh, so So nothing much on Maruti, and the stock hasn't also reacted much because the valuations are pretty low. It's trading at around FY16 valuations now, which is 10 years back your valuation that they've reached that kind of a level. So again, a huge margin of safety there. As soon as we see numbers or revenue growth, we will see good numbers. The slight disappointment for us was the guidance from the Maruti, not only for the company but for the industry. They guided for a 3% growth on the revenue side, and they said they will grow better than the industry, which means they expect industry to grow sub 3%. Now, for me, that is quite pessimist, maybe because of the urban is slowdown. They are not seeing the number and they are trying to be conservative. I think we are given the fact that the base again is pretty low for the second half of FY26. I think I will expect an upgrade in the guidance on the management in the coming quarters. Other companies which reported the number within the universe was Ambuja, Ultratech, the cement companies. Cement companies, for a change, saw both volume and price growth, unlike the traction which they have seen so far, which led to a better profitability, though cost pressure remains a bit there. I think cement is getting back on the track. And for whatever has happened in cement over the last 18 months, the new capacity additions is going to be slow, which means that when volume growth comes, the players can take a higher price increase. Uh, so we expect Ambuja to continue to do well within the portfolio company. So broadly, those were the major results. Chola also reported the numbers. Chola numbers were pretty fine, but that we discussed in the last weeks all only. So I'll now move to the next topic, which is very important, is volatility. We at Stag believe that volatility is here to stay, whether it is because of Mr. Trump or for anything. Market will continue to be volatile. One of the biggest reasons for that is I think the genre of investors has changed in the favor of those who want quick reactions, and the patience level of an average investor to get returns in investing is coming down. What I strongly believe is over the next 1, 2, 3 years, volatility is going to be very high, and hence large cap should be the flavor. Mid and small cap, the kind of carnage we have seen. Just to put you on the data, uh, Nifty has has come back to the June levels, which was June 24 levels, post these two good months, while uh, Nifty Next 50 is still 10% below those levels. Means as we move beyond Nifty, the market has not bounced, and that is very apparent from mid and small cap, the broader market. One of the reasons is as and when we see a rise, those who are stuck in them they keep selling. Also, the fact that the money is looking to get stable returns now. I think the expectations of exuberant returns have moderated among investors, and they are looking for more stable returns, which is where large cap comes into the flavor. The earnings stability in large cap is also pretty high. Hence, for me, the asset allocation going forward will continue to see more of large caps from investors, both domestic, global, institution, retail, and everybody. And hence, large caps will get bought in every correction, and those who are delivering earnings will keep making new highs. As we are seeing in some of our portfolio stocks, where the confidence of earning is much higher than others, be it Bharti, be it ICICI, be it Indigo, or some other names. So broadly, two things we at the cost of repetition I want to reiterate is earnings and large caps is where the money will be made. Now, one point which I wanted to address is how to handle volatility. Typically, an investor senses that we want to time the market. If the market is going to, if we feel that the market is going to correct, we want to say, okay, let's wait, let the correction come, let's buy at the lowest point. but we don't know how will the market react because every day a new news comes. So the best way is to handle such a volatility is the first step is to increase the horizon of investment. If you used to invest for 6 months to 1 year, please increase the horizon to 1 to 2 years. And if you are in the 1 to 2 year bracket, please increase the horizon to 2 to 3 years. That's the first step. Because while the volatility will be high in the short term, in the medium to long term, the thing that matters is earnings and the markets moves up. Like we saw, that if you would have invested the money in December, Jan Feb was pretty bad for you. But if because if your horizon was more than 2 months, in March you recovered those losses and in April you are in the money. So so the first step is to increase the horizon of your investment. The second step is to bring the beta down or the I will say the variance of your portfolio down. And that is where large caps comes into the picture. Because even in the 6 months of fall, we have seen while some of the large caps would have fallen 15-20%, hardly anybody fall beyond that. And most of them, in fact, where IT, where there is no earning, they also after a 20% correction saw a bounce. Whereas in mid and small caps, the fall can be much higher because there is a desperate exit, there is lack of conviction, you don't know what is happening. Whereas with a large cap, there is a lot of comfort. So the two most important thing you can do in the time of volatility for investing is follow the process, do the investing for a large longer period of time, decrease the beta of your portfolio by investing in earnings driven large cap. And that is what we do at Stag. And which is why we are able to generate a superior return, which is why we are able to generate a return by without worrying about taking a cash call, and which is where the investing creates wealth creation. After all, we are here to invest in the market for a wealth creation with minimum volatility. That's what we believe, that's what we operate on, and that is what we will recommend to you. With that, I will end the session now and wait for questions if any. Else, we will be there again next week, same time. We'll, as usual, wait for 30 seconds. You can put your question in the chat, you can drop me a WhatsApp. Happy to answer it. With no questions, I will thank you for taking out your time and listening to it. See you guys around next week with a new topic, but the similar ethos. Thank you guys. See you guys around.